Hey everyone, and welcome to this explainer. Today we're going to completely demystify CFA Level 1 stock concepts. And, instead of just reading from a dry textbook, we're going to do this a bit differently. We'll be using a really relatable story about a brand new business owner to unpack exactly what equity is, how it actually works, and why it matters to you. So whether you're grinding away studying for the CFA exam, or you just want a rock-solid understanding of the financial markets, this explainer is going to lay it all out for you. Crystal clear. Okay, let's dive into this. Imagine an entrepreneur. Let's say she's built an incredibly popular local bakery, right? Her pastries are selling out every single day, there are lines out the door, and she has this massive vision to turn her single little shop into a nationwide chain. But there's a hurdle. Growth requires cash. She needs capital for new ovens, new storefronts, a bigger team. So she has a pretty profound decision to make. What actually happens to her company when she decides to raise that capital by selling a piece of her dream? Section 1. The business owner's dilemma. So this brings us to the core of her dilemma. Our founder is standing at a crossroads. She really needs to fund her budding empire, and she has to figure out the absolute best way to bring money into the company without destroying the amazing things she's built. The path she ultimately chooses involves issuing what we call equity. Now, the formal, highly testable CFA definition is this: equity is a residual ownership claim on assets after all liabilities are paid. But let's think about that practically in terms of our bakery. Buying equity is literally like buying a slice of the founder's business pie. The investor hands over cash, and in return, they get a true legal stake in the company. They are now partial owners. But what does that ownership actually look like in practice? And this brilliantly illustrates exactly how that pie gets sliced up. Our founder has decided to issue shares. She retains 60% of the company, meaning she's still the majority owner, she still holds the reins, but she's brought in investor A, who now holds 20%, and investor B, who holds the remaining 20%. By taking a piece of the pie, these new partial owners are entitled to some pretty exciting things: dividends if the company declares them, capital gains if the value of the bakery goes up over time, and in a lot of cases, actual voting rights to have a say in major company decisions. Now, you might be thinking, our founder didn't have to sell slices of her pie, right? She could have just gone down to the local bank. And this brings us to an absolute exam favorite comparison: equity versus debt. If she takes on debt like a bank loan, she gets to keep 100% of her ownership, and the bank just gets a fixed return, which is the interest. But it's risky for her because she absolutely must pay it back. Equity, on the other hand, shares that risk. The investors take on a variable return. If the bakery fails, well, they lose out. But if it becomes a massive national sensation, their returns could be huge. For our founder, issuing equity provides the capital she needs without that immediate crushing pressure of mandatory monthly loan payments. Section 2, structuring the deal, common versus preferred. So our founder has made her choice. She's going with equity, but she's not totally done making decisions just yet. Now she has to decide on the exact rules of the deal she's offering to these new investors, and there are basically two main flavors she can serve up: common stock or preferred stock. Let's contrast these two clearly. Common stock is what we typically think of when we talk about shares. It gives the investor a voice, actual voting rights at shareholder meetings. But the dividends, they're totally variable and not guaranteed at all. Preferred stock, on the other hand, is a bit different. If an investor buys preferred shares, they usually give up their voting rights. But in exchange for giving up that voice, they get priority. They're promised a fixed dividends, and they get paid those dividends before the common stockholders see a single penny. Okay, pay super close attention here, because this is a classic exam trap. Because preferred stock pays a fixed dividend, it starts to look and smell an awful lot like debt. It behaves like this weird hybrid security. But you've got to remember, preferred stock is strictly an equity security. It represents ownership, not a loan. Absolutely do not let that fixed payout trick you on test day. Section 3, the worst case scenario, liquidation. Let's move to and see how this builds into a hypothetical, slightly sad, but vitally important what-if scenario. What happens if things go wrong? Like, what if a massive rival bakery opens up right next door, people just stop buying our founder's pastries, and the business completely fails and has to be liquidated? When the bakery's ovens and storefronts are auctioned off for cash, who actually gets the money? Well, this is the liquidation waterfall, and it perfectly explains that concept of residual claims. Step 1, the debt holders. The banks, the creditors, they get paid first. They have the absolute highest priority. Step 2, the preferred stockholders get paid next. And finally, step 3, the common stockholders get whatever is left over. That rest is the residual. Because common stockholders are dead last in line, they carry the highest risk, which is exactly why they demand the highest potential return. And while we're talking about risk, let's just quickly cover a few other highly testable features. First up is limited liability. This is huge. If our bakery goes bankrupt and owes millions, the investor's personal assets, like their own homes or their cars, are completely safe. Their loss is limited strictly to the amount they invested in the business. Second, dividend discretion. Even if the bakery is insanely profitable, the company is never legally obligated to pay a dividend. They can choose to reinvest every cent right back into growth. And third, liquidity. Once shares are issued, they can eventually be traded freely on secondary markets, which gives investors a super easy way to cash out when they want to. Section 4. Taking the company public. Markets and returns. Speaking of markets, let's fast forward our story. Forget that worst-case scenario. Let's say our founder's bakery was a massive runaway hit. It's now a nationwide empire, it's generating incredible revenue, and she's ready to take the company public to trade on the big exchanges. Now, when she does this, it's really vital to clarify the difference between the primary and secondary markets. When our founder does her initial public offering, or IPO, she is issuing brand new shares directly to investors. That money flows straight into the company's bank account. That happens in the primary market. But later, once those initial investors decide to sell their shares to someone else, say on a stock exchange like the NSE or BSE, they are trading existing shares among themselves. The bakery doesn't see a dime of those later trades. That whole ecosystem is the secondary market. So once you're an investor trading in these markets, how do you actually measure your success? Well, the essential stock valuation formula is wonderfully simple. Total return equals the dividend yield plus the capital gain yield. You basically make money in two ways, right? The cash payouts the company gives you along the way, and the increase in the actual price of the stock itself. Let's test that out immediately with a quick CFA-style practice question. An investor buys a stock for 100 rupees. Over the course of the year, they earn a 5 rupee dividend, and the stock price rises to 110 rupees. I want you to mentally calculate the total return right now. Think about the two components we literally just discussed. Did you get it? The answer is 15%. Let's break down the math real quick. The dividend yield is your 5 rupee payout divided by your 100 rupee initial investment, which gives you 5%. Then, your stock grew from 100 to 110. That's a 10 rupee gain or a 10% capital gain yield. Add that 5% dividend yield to the 10% capital gain yield, and boom, you have a total return of 15%. It's simple, it's elegant, and it is highly testable. Section 5. Zooming out, the Reliance Industries case. Now let's transition away from our small bakery owner for a second and zoom out to a massive real-world case study from India to see how these exact same concepts apply on a macro level. Look at Reliance Industries. Now what's really interesting about this slide is how the Reliance scenario perfectly illustrates the forward-looking nature of the stock market. Reliance made massive, incredibly expensive investments to build out their telecom network, Jio, and their retail arm. During this heavy investment phase, their current profits might have actually been under pressure, but their stock price surged anyway. Why? Because investors weren't looking backward. They were valuing the massive market expansion, the new digital ecosystem, and the absolutely huge future cash flows that these investments were eventually going to generate. And this brings us to a major takeaway that you absolutely must keep in mind, both for your exams and for real-world investing. Stock prices reflect expected future performance, not just current earnings. Even if a company's earnings are relatively low today, maybe because they're reinvesting every single cent into growth, the stock price can still skyrocket if the market's expectations for future growth are high enough. You are literally buying a piece of tomorrow, not yesterday. Section 6. Pro Tips and AI Tools for CFA Aspirants. Okay, let's pivot slightly and talk about practical execution. For the viewers out there actively studying these concepts for your exams or maybe analyzing real companies, let's explore some pro tips and look at how modern AI tools are fundamentally changing the game. Just consider this workflow comparison. In the old days, manual analysis meant sitting down, pulling 5 years of dense financial statements, and painstakingly calculating dozens of ratios by hand. It took hours. Today, AI tools like Microsoft Copilot can instantly summarize those statements, detect revenue and margin trends across massive datasets, and generate valuation insights in seconds. AI is absolutely phenomenal for highlighting anomalies and saving you hours of grunt work. But a quick word of caution here. While AI can do the heavy lifting in the real world, as a student, you must still know how to solve these equations manually because, well, Copilot isn't going to be sitting next to you on exam day. So to make absolutely sure you crush that exam, here are some rapid-fire pro tips. First, focus entirely on the concepts and how to apply them, not just rote memorization.
Second, master your formulas backward and forward, especially return and dividend yield calculations. Third, practice multiple choice questions every single day. Remember, equity makes up a massive 10 to 12% of the exam weight. Finally, avoid those common traps we talked about. Never confuse a dividend with a legal obligation, and never forget that common stock is a residual claim, sitting at the very bottom of that liquidation waterfall.
Well, we've covered a lot of ground today, from a small bakery owner's very first equity deal all the way to the multi-billion-dollar expansions of global conglomerates. I want to conclude this explainer with this final, really important thought. Stocks are not just prices moving on screen. They represent ownership, expectations, and future value creation. Every time you look at a stock ticker, try to remember that behind those flashing red and green numbers is a real business with real people taking risks and a market desperately trying to predict the future. So the next time you look at a stock ticker, ask yourself, which piece of tomorrow's future are you willing to bet on today?